Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500 that really is seeing the typical characteristics of being in its last phase. That's why there's so many controversial opinions on where the S&P 500 is going right now. You really see polar opposite views on the market right now. People expecting the markets to go in a bull run for another 20 years, or other people think that the market is going to drop like a stone straight away. Now we are coming closer and closer to a recession. That means that we are in that last phase of the bull market. Now, this is a fascinating chart that I wanted to start off with, and it's basically a leading indicator of where economic growth is going. So you've got the red dotted line here, that's the manufacturing PMI, and so that's the economy, that's economic activity. But then you've got that blue line there, and that basically is a combination of the dollar, of oil prices, and interest rates. And the reason I find this fascinating is because these are three things that we look at when we're evaluating how we can expect the economy to perform in the next few months. When the dollar is strong, that has a negative effect on growth. When oil prices are elevated, that has a negative impact on growth. And when interest rates are elevated, that also has a negative impact on growth. And you can see that blue line is inverted. So when all of these are elevated, you basically have what we've had throughout 2021 and 2022, which is the dollar, oil, and interest rates rising all at the same time. You get one of the worst readings in this indicator ever. That means we're in a very, very tight monetary environment that's going to weigh on growth. We could be in a recession by the end of 2022 and definitely, I think, by 2023. And however crazy this may sound, stock market returns in this phase of the cycle are exceptional. We had very similar type of economic data in this zone, and that's exactly what we look at every week on this channel. If you're interested in following this content with us, make sure to click on that subscribe button. And if you enjoy this video, do not forget to smash the like button. And now, without further ado, let's get right into it. All right, so I want to begin by taking a look at the recovery we've seen off the low. Now, this is very, very important to understand because recovery off lows can tell you a great deal of where the market is going in the next few months, right? Just the first few days of the move, like in 2016 or like in 2019, these moves told us that we were set for big runs in the months to come. And that's where I want to show you this chart right here. And this is the 4-day breadth of the Nasdaq 100, so the technology ETF. And it measures how strong the breadth is on the Nasdaq 100 in the last 4 days. And you can see here last week, we had one of the strongest readings on this indicator. In fact, the strongest reading ever on this indicator that tells us that the rally off the bottom here that we saw last week has been very powerful and very strong in terms of the breadth. And that is the total participation in the breadth. And you can see this only happens a handful of times in history where we cross this blue line here at around 85, and it systematically corresponds to major bottoms and major beginning of a leg up. Right here, even the bottom of the 2003 bear market was signaled by a breadth thrust. So that's already a very promising indicator right here. This is not the type of thing that you see in a bear market rally. You see right here, very little breadth on this bear market rally in 2007. All of these bear market rallies right here, they had limited breadth, so limited condition, limited convictions behind these moves, not the same type of behavior we're seeing right now. So that was just a quick chart, quick data on what happened last week, maybe putting some of the things you're seeing online into perspective. But the main topic that I want to cover in this video is the Dow to gold ratio. Now, this is the stock market, so the Dow Jones divided by gold. Right? So gold's performance. Now, the reason we look at this chart is because it's probably one of the most powerful charts that exists in the financial markets. Gold is the ultimate hedge against a collapse of the financial system. Whether that collapse is big or small, it's a major hedge. You can see 1929 here, massive outperformance of gold against stocks. Throughout the entire 1970s here, major outperformance of gold against stocks. Between 2000 and 2011, major outperformance. You know, these are massive moves. If you can successfully catch them, they can be incredibly profitable. And just to give you an idea of these moves, let's jump to a weekly chart here of the Dow to gold. This is 1999 to 2011. Between that period here, gold outperformed the stock market by 650%. Now, just let that sink in. That is absolutely massive. Anyone who has experience in the financial markets as an investor will know this is just a mind-boggling number, because it means that not only you avoided this entire period in the stock market, right, that was extremely poor in terms of performance. Let's put up the S&P 500. Between 1999 and 2011, the markets went absolutely nowhere. In fact, they came down. Gold went up massively throughout that period. So you were able to buy stocks at a discount, having appreciated your buying power. Now, based on the targets that we have for gold in 2025, and the expectations that we have for the stock market to underperform, that's based on, simple valuation indicators that give you insight regarding long-term returns, right? This doesn't predict the short-term price action, but it gives you an idea of long-term return on the stock market. We're absolutely massively overextended when you look at equities as percentage of GDP, which is economic output. You would expect equities to be in proportion to the economic output. Even looking at equities as percentage of total assets, we are massively overextended. And of course, that's reflected on the allocation to stocks, which is also near all-time highs. And typically, when you have stock market allocation near all-time highs, that leaves the door open for massive drawdowns. So hopefully all of this makes sense. When you have longer term periods of market underperformance, gold tends to perform well, especially when you have monetary debasement where you see the money supply just skyrocket, which has been the case throughout this period and which was the case throughout the 1970s. Gold is the ideal asset to hold when you have that type of macro environment and you have a financial system that is overextended. And this is absolutely a massive part of our longer term macro strategy at Game of Trades. We've been big advocates for holding gold longer term, and that remains the case. For example, here, these articles and videos that we posted throughout the end of 2021 and towards the beginning of 2022, we talked about the huge potential turning point for gold and its use case as a hedge against an overextended financial system, which, by many, many measures is the case. So let me quickly show you this premium video where we talked about the equity versus commodities cycle over the last 50 years. We talked about how gold tends to perform during a recession and most importantly, during a big deflation, right? Gold is a protection against deflation, not just inflation. Because when you have a financial system that's collapsing like you had in 1929, where do you think that money goes to? It goes to safe haven assets, and gold is definitely a part of those. And right as the Dow to gold was testing that big level of resistance from that massive price channel that we have on our long-term chart, we talked about the potential for gold to outperform potentially 500% against the stock market. So similar to the returns that we had right here. But most importantly, we talked about the relationship between the Dow to gold and the economic cycle. And we said that in the current phase of the economic cycle, it's very, very likely that you can see a top in the Dow to gold and begin to see gold outperform the stock market. Now, what do I mean by that? What do I mean by economic cycle? And most importantly, what's going to happen now? How do I take advantage of that? Very simply, the economic cycle, you can use the yield curve. When you've got an aggressively flattening yield curve, it tells you you're towards the end of an economic boom and you're about to see a significant slowdown and potentially a recession. And you can see every time you have an aggressively flattening yield curve that's trending towards that zero line where you can have an inverted yield curve and you can get a recession, that moment where the yield curve is flattening is where you get a top in the Dow to gold ratio. We had that back here in 2018. We had that right here in 2005, 2006, big top in the Dow to gold. We had that right here, flattening yield curve in 1999 and a big top in 1999 on the Dow to gold. And of course, what happened in 2022, flattening yield curve, and we have a top in the Dow to gold ratio. Now, what's next? What comes after that? And you can see systematically, and that's where we're going to get back to the stock market, because that's, after all, what we're talking about here. Systematically, you have a bull trap scenario form on the Dow to gold as you have the yield curve invert. The same thing happened back here in 2006 and 2007. You have a bull trap here where you briefly see stocks rally as the yield curve is inverting. You can see it happened here in 2018 as well. You have a period of consolidation before this move down resumes, and that's exactly what we expect this time around. As the yield curve will be inverting, we'll be expecting this consolidation. And by the way, let's look at the stock market in these periods right here. When you get that bull trap, these are massive moves up. Let me quickly show you the returns on this. You know, this was a 17% run up to the all-time high. In 2006, again, this was a almost 20% run to the all-time high. In 2019, this was a massive 70% run to the all-time high. So that's where we think that we're currently at on the Dow to gold. And that's absolutely great because stocks perform well and gold performs well. And I think we're going to see some pretty big opportunities in this zone here to rebalance our portfolios and make some pretty big trades in this range, similar to the type of trades you could have made in 2019, in 2007, and in 2000 right here. Of course, we will be posting frequent updates on these trades, giving you guys in-depth analysis on where we think the opportunities are, how we're seeing the current market. If you're interested in having access to these articles and any other future articles with, of course, notifications, make sure to click on the link down below. Test out the free trial on our service. And the last thing that I wanted to cover on this video is the S&P 500 seasonality. Now, seasonality isn't something we weigh in too much. We prefer to focus on all of our other indicators, sentiment, intermarket, macro analysis. But you know, seasonality can be helpful. There are certain driving factors behind these correlations, with certain periods corresponding to stronger equity performance and some weaker equity performance. For example, during the summer, that's when people go on holiday. You tend to see weaker economic numbers, weaker economic activity, and so you have weaker performance. And then towards the year, you have all the holidays, Christmas, Black Friday, return from vacation, and everything is booming. You also have a lot of buybacks towards the end of the year. But the fact of the matter is that the end of March, April, and the beginning of May are great moments historically to be in the market. So that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to leave us a like and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.